There we go. Right, let's people are still coming through. So what we'll do, we'll take a slow start as we're sort of 1 minute past, and I want to make sure everybody gets enough value from this. As I can appreciate, you're all very, very busy. I do have quite a bit of content to get through. I'm going to whiz through that really because we've got about 16 questions that have been submitted from everybody. So really good questions. So thank you for those that did take the time to send us a question. At the end of the webinar, there'll be a very short feedback form. It's just a click button exercise. It's a great way of us knowing how we're presenting the webinar, the content, and whether you got value from it and how we can improve moving forward. So if you wouldn't mind, when you close down the webinar, just give us a quick bit of feedback, and we can know if we're doing stuff okay. That's the most important thing. So let's get into it. I'm Lee from the Financial Planning Club. I'm with David O'Hara from Corbel Partners today, and this is effective succession planning for financial advisors. It is a huge topic at the moment. What with the advice gap, we've got a lot of people with one eye on retirement at the moment, and I'll go into that and I'll show you a little bit more about that throughout the webinar as well. So as we come on onto the Financial Planning Club, our mission is to really connect individuals, enable them to collaborate, and empower advisors and business owners to really excel and grow their businesses. We find that the industry is a very isolated role. Everybody feels very isolated, and there's not really a community where people can reach out, support, and collaborate one another. So that's what we've done with our WhatsApp communities. So we've got a WhatsApp community for financial advisors. There's probably about 160, 170 financial advisors in there. And it's all about just supporting people with hints, tips, and ideas, and whatever that may be. So it's a really cool place to hang out. If you want to lean on some of your peers for some collaboration, please let me know, and we'll add you into the WhatsApp group as well. So yeah, that's really good. So a bit about the Financial Planning Club and why we launched it. For business owners, we are supporting firms with growth and development, operational efficiency and productivity, people and culture, business setup. We're running face-to-face events and bespoke workshops. We've got the tools, the systems, the templates, the industry knowledge. The people that are coming together to really help business owners succeed is very important. 80% of our market is SME businesses. So 80% of financial planning firms have 3 or less advisors. And we want to do everything that we can to give them all of the tools and resources to really break that barrier and start becoming sort of medium-sized financial planning firms and start bringing on advisors, because there is an advice gap in the market, and it's going to be coming to us quicker than you know it. It really, really is. So for individuals within financial planning firms, as mentioned, we've got about 5 different WhatsApp communities now. Whether you're a mortgage advisor, power planner, financial advisor, ops manager, or an administrator, we've created really cool sort of hangout places on WhatsApp for you to come on and ask any technical questions that you may have. Webinars such as this, resources, we do get discounts from leading training providers as well. So whether you are on the journey to chartered, some of our partners such as Brand and BTS enable us to basically pass on discounts for you, which is fantastic. We've also got bespoke study groups as well within our WhatsApp community. So if anybody is studying for a specific exam, mainly on the road to chartered, then we've got some good WhatsApp groups where you can come in and collaborate. All right. Moving on to Corbel, and the reason why I wanted David to join us today, because he is in the midst of this day in, day out at the moment. So just to paint a bit of a picture about Corbel Partners, they was formed in 2004, evolved over time. I think you're sitting at around about 155 advisors, David. Is that about right? About 155? A lot of those set up as ARs as well. I think, David, you're muted actually. How do I
Sorry, the sandwich van had arrived and it was in the
it's the 10 o'clock sandwich van. We've all got one of those.
Safer.
Yeah. So I think you're sitting about 155 advisors now. I think about 52 are set up as ARs as well. So it's a really cool business that you're running. Multi-award winning as well. Best Advice Network, Best Financial Advisors to Work For, Top 100. I know you've been put forward for a couple of more awards this year. Is that right?
That's correct. Yeah. We keep applying and they keep making the shortlist, so we're not complaining.
No, definitely not. Success. You've had some great success last year. 14.3 million, 14.3 million is the figure that I've got, but I think that was closer to 15 if I'm right.
Yeah, we went through 15 million in
Fantastic.
the last set of accounts. So there's nice steady growth each year.
Steady growth. 2.2 billion assets under management as well. So that's really exciting. So you've got a solid business, great foundations. You've launched your own platform as well recently as well. So that's really good. But the main thing is, and the main reason why I wanted you on this webinar is because you are successfully enabling advisors to retire. And this is in no way, shape or form, you know, a picture about Corbel, but I just want to really pick your brains about the do's, the don'ts, the ifs, the buts, the challenges that you have come up against and everything in between, really.
Yep.
So we'll definitely touch on that for sure. To give you all an idea of the financial planning landscape, so typically us as a business, we monitor 3 areas of the financial planning industry. So that's holistic financial planners that have got full advice permissions, wealth managers, and wealth advisors, wealth investment advisors. So full permissions, but they're not actually doing any mortgages. So when we look at the firm type, the total number of firms and the total number of advisors, we're sitting at 10,282 firms in the UK financial planning space, with 36,043 advisors. So it's a good market. It really, really is a good market. So this is excluding bank assurance, anybody working within a bank. This is purely sort of financial planning firms. Size of firms as well, we do break that down to the size of firm. So micro being 1 advisor firms, small up to 3 advisor firms, medium, large and very large, and so on. So as you can see there by the figures, just over 8,000, if you like, are small and micro firms. So the majority of the market is an SME marketplace. You will see that the large and very large firms are home to most advisors because of the likes of the St. James's Place, the Quilters, the Corbels, that are, you know, the homes for many, many advisors. What's important though, again, relating back to the webinar about succession planning, is who's joining and who's leaving. So with the data that we get from the FCA, we can see that 10% of the market is new within the last 3 years. So out of the 36,000 advisors, 3,615 have been authorised and they're within their first 3 years of advising experience. So these have all got CPD4 permissions, which you need to give financial advice within the UK. So 3,615, 10% of the marketplace is new to the industry, if you like. If we look at the other end of the spectrum on who is potentially leaving, now this is where it's a bit of a scary figure, if you like. 46%, so 16,882 advisors probably have one eye on retirement. So there's a massive, massive gap as to how many people are leaving, how many people are joining. There is a massive, massive gap in the advice space at the moment. And if you follow the stuff like the Consumer Alliance and the New Talent Alliance that's being launched at the moment, all the people from the big places are coming together to see what we can do and how we can help firms bring in newer advisors, because there is a huge population out there that needs advice. There's not enough advisors and so many advisors that are looking to retire. As I said, I had loads more slides and I wanted to give you loads more information on the market. But the reason why you're all here today is because you want to hear from David and you want to hear about the challenges that he's faced and how he's helped many advisors and what you all should be doing and shouldn't be doing to have a seamless transition into succession. All right, so into retirement. So David, let's get into the first question.
Okay.
How long has your business been assisting advisors with retirement planning?
Well, we've actually been trading 19 years, but the retirement planning actually started about 3 years ago.
Yep.
Because you can see the way the industry's moved. There's a lot of consolidation, and there's a lot of consolidators out there that are trying to, you know, snap up businesses and firms, and you know, it's very much a free for all. We wanted to. We have obviously as a group, we're quite a young group. Average age is probably sort of mid-40s. But we did have a band of advisors that were in their 60s, 70s that wanted to retire. And basically, they asked us to help.
Yeah.
So that's how we came about with our retirement package for advisors. So we're not out in the market trying to consolidate or buy anybody else. No. It is literally a retirement route for everybody within the group, because we've had a legacy bringing advisors in and training them, getting them through chartered exams, etc. But we didn't have the final solution in place for them for when they retired. So we put that in place about 3 years ago, separately. So that's it.
I love the three options that you give advisors that are under your business, if you like.
Yeah.
The option is, we'll buy it. You can sell it to an advisor within the group, or you own your own clients. You can go to the whole of market, right? So you can.
I think it's important that, because retirement's a big step for an advisor, and you've got to be clear yourself in what you want to, what you actually want to do, and what you want to achieve, not just for you but for the clients. So we've always worked on the premise. I think it's important that you should have access to all the options. You need to make sure you're getting the right outcome yourself. But actually, most advisors are more concerned with the outcome for the clients. Actually, if I'm honest, that's where it sits. But we want to give everyone the freedom to do it.
Absolutely. On to the next question.
Yeah.
Have you noticed any significant trends or shifts in succession planning over recent years? So in the last 3 years, or historically, you've probably seen and heard it, from back in the day when you first launched to today. What's been the biggest trends that you've noticed?
The biggest trend is that you've got there's more consolidators. We're starting to see the consolidators buy the consolidators now. So what you tend to find is that you can achieve high multiples if you're prepared to if you're prepared to move your clients to one of the vertically integrated operations, where they're both either the product manufacturer or the distributor with their own investment solution, that kind of thing. They generally will pay higher multiples on your business, because they're taking a slice all the way through the process. That's probably been the biggest trend. What we're seeing actually now is that a lot of advisors are moving away from that, because whilst they were initially attracted by the higher headline rates, the focus is certainly very much on what's going to happen to my clients going forward. Because I think as information gets better, everybody understands the implications of the decisions they're making and the impact that's going to have. And advisors, I'd say, are possibly becoming a bit more defensive in that they understand that if the client's going to be majorly not upset but moved in that sense, that they're going to get the tap on the shoulder in Waitrose or Sainsbury's from one of the clients when they bump into them. And they don't want the conversation of what did you do to me? So that's
it's kind of a question you've got to ask yourself: is it multiples or is it the clients? And what's important to you that when you want to retire? Is it the multiples? You just want bang for your buck and you're out, or is it really that the clients? Because you said most advisors, your clients are your friends, your family, or they've become your friends, and you might see them on the golf course or in whatever that may be, and you want to be able to still say hello with your head high, knowing that they're still very much looked after. Nothing's really changed for them, and different horses. Everybody's circumstances are different. We get that, but it is kind of they're your options. What's the driver? When it comes to that.
That's the key thing. It's actually finding out what the motivation, exactly what you want to achieve as an advisor, exactly the same way as you do when you're building your own advisory business. It's what are you aiming for? What are the outcomes that you want to achieve for it? And there's no right or wrong answer in this. It is very much about finding what you can live with. I think it's the easiest way.
Absolutely. What are the key steps an advisor should consider before deciding to sell their client bank?
Right, from an advisory side, it's a really interesting question, this one. There's actually two sides to it. The first one is, in terms of key steps, the obvious one is make sure you've got good client data, because that's what a purchaser, be them, whoever they are, will want. So, and particularly in light of consumer duty, they want to make sure you've got clear evidence of servicing and so on. Actually, that's probably secondary. I'd say the key steps that you need to decide is how you want to retire as an advisor. Do you actually want to retire? And I know that sounds like a daft question, because we're talking about people selling their client banks, but actually it's probably the most relevant question to ask yourself. And it's not, do you want to retire? The question we always say to everybody is, when you retire, what do you want to do?
Yeah.
What are your plans? Have you got hobbies? Have you got, traveling plans, etc., etc.? Are there health issues? Because what you tend to find is anyone that says, well, I'm going to retire, but I don't know what I'm going to do, that to me will be, on a personal level, will be a red flag.
Really?
Because you need to know what you want to do.
Yeah.
Because it might be that, literally you've had, maybe it's a heavy Thursday night and it's a Friday morning with a hangover, or maybe it's just a Monday morning blues in the middle of winter.
Yeah.
So it's very much about actually deciding what you want to do and what you're going to do when you retire, because what might be a better solution would be to phase retirement rather than, going cold turkey straight away. So it's about making sure that you know on a personal level really what you want to achieve personally from it in terms of how you want to retire.
Because it's the letting go aspect, isn't it? It's the
Yeah.
if you've got no plans, you'll keep going, because chances, I mean, if it was me personally, my wife would have me doing so much at home. I'd probably be thinking, oh, I'd rather be out seeing my clients, So it's about having plans in retirement, or as you said, maybe it's a phased retirement. Maybe you sell a proportion of your client base. Maybe you sell 80% and just look after 20%, and you have a bit of a part retirement kind of setup.
That's it. Yeah,
Which would be quite nice.
It's about giving yourself the runway that you want, and you start, because realistically, if you're thinking of retiring, you need to start sort of prepping the clients. I'd say 18 months, 2 years in advance almost. Not that you're going to say, look, I'm retiring in 2 years, but it's more getting them used to the idea that things may change, as in your advisor might change. You'll always look after, making sure that the new advisor's in situ, but it's very much about trying to make sure that you don't sort of go cold turkey and then sit there and sell your business on a Friday, wake up Monday morning and think, what do I do now?
Yeah.
Because that's the beauty of this profession, is that actually technically, if you don't want to, you never do need to retire. I mean, the oldest advisor in our group is 80 years old.
80 years old.
80 years old this year. He looks 60.
Really?
He's sharp as an ant. He loves his clients and he just loves the job. And it's brilliant. When you meet him, you get excited because it's got so much energy. And that's fine, but it's about determining what you want to do and making sure your retirement is planned. The people that we've seen over the last couple of years where we've helped them retire, they've gone for very, very specific reasons.
Right.
They have things to do, and that was good. It was a very, very easy transition for them. With other people where they're easing into it,
so
they're ready to go.
That advisor that's 80 years old, can I assume that he's not running around looking after 150 clients still? Is he got the phase retire? Is he looking after a smaller?
He keeps this year. He said he might be looking at phasing a little bit because he thinks at 80 he should do.
Don't overdo it. Yeah, he should. So that tells me he's being told by someone else that he needs to start slowing down a little bit.
Quite possibly, but I mean, the problem is he loves his clients, loves his job, and he just loves his business, and it's what he does, kind of thing. I think he's saying that he might decide to phase a little bit this year. Personally, I wouldn't like to bet any money on it.
No. Fair play to him. Fair play to him. Are there, I know you've touched on the 18 months in terms of letting the clients know, but are there preferred timescales for planning and executing a buyout from your standpoint? I mean, if somebody come up to you, obviously different circumstances, we've heard where people have had an illness and they've got to sell, and whatever that may be. But is there a preferred timescale where you say, look, guys, girls, just give us a little bit of a heads up, because ideally we need this time frame to go through the compliance, everything your side?
Yeah. Well, if you're selling to an external, so basically there's two sides to this. Internally for us, it can be very quick because we're buying what we already have the risk on. So compliance isn't really an issue. The thing to bear in mind is if you're selling to an external party, they're going to want to do due diligence on your clients. They'll probably want to sample some of your files. They'll want to, evidence of things like earning. They want evidence of income. So there will be an information gathering exercise, and you need to give yourself time to get that information to them as well, because it's not something that generally is a rule you pull out overnight. So you've got to start prepping the clients, I would say. Ideally, 12, 18 months in advance, tell them that you're looking to retire, because you want to get them settled. Because what you don't want to do is sell your client bank, and then clients feel it's a shock, and then all of a sudden they start looking for a new advisor.
Yeah.
Whereas if you're prepping them in advance, they understand that you're going to handle the transition. It's a much, much smoother process. So then if it's externally that you're selling to, I would suggest you need all the information ready, because that's going to be, they're going to be asking you for that. So rather than saying, well, look, I'm going to sell today, and then all of a sudden you get a massive data request that takes you 3 weeks to pull everything together, and you've literally got to stop work for 3 or 4 weeks. If you give yourself a run in to it, you can have a lot of the information prepped and ready, well in advance, is what I would suggest. You can do it quickly if you want to. Certainly, if you're selling to an organisation you're already part of, it is a very quick process, because a lot of there isn't really the DD to do, because it's already done.
Done.
Yeah.
Can I assume that the quicker sales, as in whatever, need to get out sooner rather than later, can I assume that the multiples might be lower than somebody that's giving you a bit of a run up?
No, it doesn't make any difference.
Okay.
Because the value is the value of the business.
Nice.
You'll always get multiples will change if you're using things like an earnout, where because firms do it where they do it as an earnout. You would expect a higher multiple than someone who's basically than say a cash offer, where it's generally with cash offers, you tend to find it's a big lump up front. You probably get you'd agree a multiple, you get usually 50% of that multiple up front on day one, and then you'd usually get 25% on at the end of the first year, 25% at the end of the second year, and that seems to be pretty much standard throughout the industry on that side. If you're doing multiples, you'd expect an earnout. You'd expect the multiple to go up, because obviously they've got the benefit of not paying you for a longer period, so you should earn more. Really.
Fair enough. Yeah. So you'd obviously take a longer run up at that aspect. If you're thinking about retiring in 2 years, and you want to scale it over to get a higher multiple, then you want to start bringing that a lot more forward, don't you? Really? Yeah.
So it's about basically. If you've got clients, for example, if you're thinking of changing your charging structure, so in light of Consumer Duty, a lot of advisors have changed the charging structure and actually put the fees up. So you'd make sure that was done prior to sale, because you're on a bigger multiple. Because you don't necessarily have to have it done for a year before. What you need to do is basically, and again, this comes back to the record keeping aspect as well, because if, for example, you have a client that you pay that's paying you X, and you've increased your fees and they're now paying you Y. That will be, you'd expect a purchaser to multiply that over a 12-month period on the higher value, not the lower value. On that side, and they can do that if you've got the records. And it comes down to it's about the good record keeping.
And I know I've got a question on technology in here as well, so we're definitely going to touch on that for sure. Next question is, from your experience, are advisors concerned about the future handling of their client bank? Now, I know for sure some are, right?
I would say, well, for the ones that we speak to, that's the number one question.
Is it really?
Yeah. What you tend to find is that that's number one question above even price
Really?
for all advisors. If price that you say, as I mentioned earlier on when we hit on the first question, if your motivator is multiple, the firms to go to. We all know who to go to, and that's fine. And really, at that point, the client bank is secondary, because you're selling on the basis of price, and that's fine. That's what we want to do. The number one question, and it's the number one question you need to be asking any purchaser, be them internal, external, or even somebody that if selling to your mate around the corner, is what's going to happen to the client bank, because we've seen it in the past where certain purchasers basically they buy a client bank, and then literally they pull maybe 30% of it straight away because they don't meet the criteria. So all of a sudden your clients have been told, well, you've been sold. That's unsettling. And by the way, you're no longer paying us enough basically for us to keep dealing with you. Go and find another advisor. So it's or the investment solutions that you've recommended as an advisor today, they get moved to another company, and tomorrow that all has to change because no longer their investment solution. So these are important questions to answer. It's not that if you're moving to a firm, if you're moving, for example, to a vertically integrated operation. I mean, we're not. If you are, ultimately, what you have to accept is that even if the client is going to stay on, say, the account that they're on now, that they're going to end up being moved into an investment solution that firm has. You need to be aware of that, because
of course you don't.
You almost need to prime the clients on it, because from the client's point of view, they're going to go, well, Lee told me that this was a great investment. Now all of a sudden Lee's retired. It's not a great investment. Why is that?
100%.
And again, it's to avoid the tap on the shoulder in the supermarket. It's awkward questions that you don't really want. And it can work. It can work for you in the sense that if the new investment does really well, okay, it's fine. But if it doesn't, then it's, well, you've not only left me behind, but you've put me into something that you've put me into something rubbish as well. So it's about basically managing the client's expectations, I think, is the important.
So quick question on that. So I don't know if we're going to cover this on here, but say a multiple is agreed.
Yeah.
You've had your first 50% payout, and you got the 2 years to receive the remaining 50%.
Yeah.
If they're suddenly shoehorned in to a essentially, like, whatever it may be,
Yeah.
but they take that as an opportunity to start exploring their options and maybe go with a different advisor. If they essentially lose that AUM, does that affect the multiple that was originally agreed? Yeah. So it's important that
client retention is number one.
Number one.
And that's why it's important when you're selling your clients to be asking the questions that you don't really want to ask.
Yeah.
Because even leaving the client outcome aside for a moment, from your own selfish point of view, you need to be finding out what's going to happen to those clients. Because ultimately, if those clients decide to walk, that will affect your money.
Yeah.
And I know multiple money might not be the primary motivator, but it's still a motivator.
100%.
So you want to make sure that you're protecting that value that you spent your life building.
Yeah.
Walking out the door because somebody else has decided.
Yeah. Listen.
In the same way.
It is a phased retirement for me. If that was the case, it is a phased retirement for me. A bit of a control freak. I'd like to make sure that everything stays in and everything's sticky. And I wouldn't want to just go, thank you, see ya, because again, it's completely out of your hands. You've got no control over it. And that would drive me insane, waking up thinking, wonder if he's still with them, or wonder if they're still with him. Yeah, so definitely I'm opting for phased retirement.
I think most of us are control freaks. I mean, to be fair, we always introduce the selling advisor to the advisor or advisors.
Yeah.
Clients.
Which makes sense, right?
Yeah, it makes sense. I mean, if we're having to bring a new advisor in for a particular client bank, we'd usually, when we get it down to a shortlist, we'd usually ask the vendor, whoever's selling the client bank, to interview the prospective candidate that we think will be suitable. Because it's important. You need it to be a good fit. And as a seller, you need to make it. There's no reason why you shouldn't meet the person that's going to be looking after your clients. Because if it's not going to be a good fit, you need to be having a conversation with the purchaser, to be quite honest.
Question on that: have you had that? Have you had it where the advisor's reported back and gone, "Listen, David, I don't think he's going to suit my client bank"?
We've been fairly lucky that we haven't, but we haven't had that because we've always insisted that the advisor that's retiring within the group meets, and that's fair, they already know the advisor that's taken over.
Yeah.
On that side, so they're comfortable with it, and it means that again, when they're handing the clients over, they're confident because they know who they're handing them over to.
They know it is. Yeah.
But if I was in the position of selling my clients now to an external buyer, that's would be certainly one of the top questions I think you'd need to be asking is, I want to meet the advisor that's going to be dealing with them. So you know who's looking after them.
And you're in every right to do that, right?
Yeah. I mean, it's your clients.
Well, yeah, exactly. Yeah, exactly that. I mean, if they say, "Well, hold up, no, you're crossing a line," then you need to really think about, is this?
I'd be thinking if that's the way they are, then you might want to be looking at a different purchaser. Will probably be in my head.
Yeah. Oh, but the multiples sound great. Okay. What we're here for.
That's it. Yeah. And I think ultimately it comes down to what you want to achieve yourself. I mean, if multiples are your motivator, and again, there's nothing wrong with that.
No.
It won't matter.
Yeah.
What we tend to see is that the multiple actually is usually question 2 or even question 3 on the list. It's usually question number 1 is what's going to happen to the clients and is anything going to change?
Well, that's nice. That's actually nice to know. Instead of how much am I going to get paid, it's talk to me about the clients. And I spoke to an advisor yesterday, and I'll be brief because obviously we've still got a bit more to get through. But again, sold his business, and he met all the usual names in the industry, and he went with a business that just aligned with his business, and it was that alignment, and it was that client integration. It was just everything just worked for him on a client perspective. Then the multiples followed. So it's good to see that. It's good to hear that as well. Now, where does the true value of a client bank lie? and how would you, or how do you determine its worth?
Right. So generally, with a client bank, they're currently valued on the ongoing income. So
Yeah,
it's on about recurring fees. That's done primarily because the recurring income is the value of the business.
yeah,
So it's that determines everything on that side. So you would expect a purchaser basically to say, well, we will pay you a multiple of that recurring income,
mm,
over a period of time, either upfront or over a number of years, depending on how you want to structure the deal. What everyone what advisors can always remember is that at the end of the day, they're the ones in control of this.
yeah, yeah,
So they can, most purchasers will try and structure a deal to make it work for the advisor. So if they want a bit of a quirk in there, you can usually ask. There's certainly no harm in asking.
no,
So its worth is on recurring income. What another thing that's going to be a determining factor as well, now I think going forward, will be evidence of servicing, because
absolutely.
having seen the way sort of I know SJP have been slated recently, for having to refund servicing fees and so on, and looking at the way the FCA, the information is coming out of them as well, you will find that purchasers will start to, particularly when they don't know you, this is more relevant when they don't know you, they will be saying, look, we need evidence of servicing, because even, if you've got a client paying you, fees for the last 15 years, but there's no evidence of servicing on file, you know that if there's a complaint, chances are that those fees are going to be refunded. And the purchaser will want comfort that is not going to happen.
Yeah, yeah, that makes sense. Let's talk about clients over a certain age, if you like.
Yeah.
The ones that are probably not accumulating wealth anymore, probably
Yeah.
giving it away, handing it out, handing it down, or I suppose generation planning comes into place really. But
Yeah.
what effect does that have on a client bank?
You tend to find, historically and traditionally, you would expect clients over 75.
Yeah,
Now,
yeah,
again, it depends on some firms, say family groups, some say no clients over 75. I've actually seen a contract the other week, which was clients over 65, which I
wow,
think is taking the mickey, where basically they weren't prepared to either buy them at all, or they wouldn't feature in a capital payment. It will be on an earnout. Realistically, clients over 75, you would expect to be paid on an earnout rather than, over a period of maybe 4 years,
okay,
rather than including a capital purchase. So, and the reason for that, if you think of the economics of it, if somebody's paying, say, 3 times, as a multiple, and they're having to pay a salary as well, 50, 60,000 pounds, whatever it may be, to an advisor to look after those clients, it's going to take, the break-even point is, 5, 6 years down the line.
yeah,
So if someone at 75, you're asking them to live to 81 and the wealth not to decumulate over that period as well. So 75, you would expect really to be on an earn out. If anyone's saying less than 75, I think they're being unfair, personally.
unfair. 65. I mean, you're not even at retirement yet, are you?
That's what I mean. It's 65. I mean, there's people at 65 still in accumulation. They've like decumulation.
Yeah,
So,
absolutely.
yeah, again, it does happen. So I think 75 is the realistic age. Anyway, and again, if it's a couple, and that one of the spouses are under 75, so you say one at 73 and one at 76,
Yeah,
you would expect it to be valued in capital to that point, because one of them is 70, is under 75.
yeah,
You wouldn't expect just because husband or wife is older for them to be excluded.
yeah,
It does happen. So again, it's going to it with your eyes open,
yeah,
from there. But realistically, fair price in the market is under 75. You should be able to sell as a capital sum without any issues, and that will be on a family group basis. So as long as one of the spouses is under 75, they should be featured in that. Of 75, expect it will be an earnout.
yeah.
It'll be a slightly long period. It might be usually 3 or 4 years.
And to me, that makes sense, right? That just makes sense to me, to have it on an earn out, really. What valuable lessons have you learned from your past experiences? So I can imagine there's been a few, right? Especially if you look at what you did on the first buyout,
Yeah.
to your most recent buyout. What have you learned?
To manage expectations, because
Okay.
it's very easy. It's to get a clear understanding from the advisor about what they want to achieve when they retire.
Yeah.
because sometimes it can be very, very difficult, because at the end of the day, you're giving up, not giving up, but you're selling your life's work.
Yeah.
And it's about basically being able to get people to let go of that, but in a way that's gentle, without, you know, pulling the rug. That's the hardest part of it, to be quite honest. I think for we've had it with a couple of guys where they retired because health was dictating it.
Right.
They very easily let go. It was no problem. We've had it where others, you know, where they think they want to retire and get down through the process, and then think, actually, I'm not quite ready to go fully. And again, it's about making sure the deals are adaptable enough that, you know, if you get to almost, you know, to the line, and someone says, look, I'm not quite ready to go fully yet, then you can change it and make it agile enough to suit what they want to do.
Yeah.
Because you don't want to be forcing people out the door.
No.
And that's from our lesson. With the lawyers, we've learned the lawyers now are agile enough that we can change a deal partway through.
Yeah. No, absolutely. It's not one rule fits all, is it, anymore?
Yeah, you'll never get one size fits all. All deals are approximately the same.
Yeah.
In terms of value, but you will find that there'll be tweaks in there just to accommodate someone, you know, something that someone wants to do.
Yeah.
You know, they might be that they want to keep their authorization and hang on to, you know, 5 or 10 clients or 20 clients, and that's fine. You know, but our lesson from that is not to be too rigid, because rigid creates tension for everybody. Of
course it does.
And it's because, you know, you can be agile enough to this, because it is, for us, it's not about buying business. It actually is a retirement plan. So we want to see our advisors enjoy retirement, not sort of, you know, be forced into it kind of
thing. Yeah, absolutely. What top piece of advice, and the last question we've got for you before we go into the questions that have been submitted by others, and we have had a question come in on the chat as well, so I'm going to touch on that as they're in the room. What top piece of advice would you offer to an advisor considering retirement?
Have a clear plan of what you want to do in retirement.
Look,
number one.
I've spoken about this for years. Advisors are excellent at planning other people's retirement, but terrible at planning their own retirement. And I don't know why that is, but you guys and girls are terrible at planning your own retirement, but excellent at working with everyone else on their retirement plans. So that's brilliant. So submitted questions. So people that have registered have submitted some questions. But as we've had a question come in with somebody that's live, I just want to make sure we get this answered. So in addition to multiple of ongoing fees, is it realistic to add a sum for potential new business? So if they're at that stage of suppose selling, but they've got a pipeline of business which is going to add on an additional sort of recurring revenue, is that included?
You'd expect it to be. And what you tend to find is, by the time someone's coming to retire, they usually get all the initial business is normally done.
Okay.
And what you would usually say is you put in, because once you're not dealing with that client, don't forget you're selling it, so you're not going to deal with them anymore. A new advisor is going to take over, and we'll be looking after that client going forward. But there may well be, you know, business that you know is going to come in, you know, 6 months, 8 months time for whatever reason. But you're not going to have, as the seller, you're not going to have the cost or the time or anything else of dealing with that. But you would generally ask, you know, it's not unreasonable to put in for the first, you know, year or couple of years, particularly while you're on your, you know, you get your 50% and then your 25 and 25, to have an income share on any new business that's written, because that may well have been lined up by you in the meantime. So you kind of expect, my advice would be, is if you've got a pipeline business, you know, that you know you're going to write the next month or so, then you'd get that completed before you complete the sale. Because then you can factor in 12 months fees from that as well going forward, and that increases your purchase price. So good incentive to do that.
So any deal done after point of signing on a dotted line, you would expect an income share of the initial, but it's not as if you'd get to the end of the 3 years and go, oh, but you do realise I've added another 20 income. Can I have another multiple of that?
Because what you have to remember, it's not you that's adding it. And that's the point, because and this is the hard part about when I say about have a clear plan of how you want to retire, because it basically are not your clients anymore. They are, but not, because you're selling them. So it's if there's any new business written, there will be usually in the first 12 months that you know, there'll be things like you know, there might be potential inheritances or retirement or whatever, you know, that's going to trigger lump sums to invest. So at that point, it's not unreasonable to say, look, for the first 12 months, if there's any new business written, I want 10% kind of thing.
Nice.
Fees.
That's good.
That's reasonable. Ongoing fees, that wouldn't be a feature, because you're not responsible for either bringing those fees on or servicing those fees either. So I'd always say, when you come into retirement, make sure you clear your pipeline, get that in. Or if you're not going to clear it, then it's a conversation with the purchaser.
And you'd like to think that's going to be an adult, sensible conversation.
Yeah.
It's obviously going to be very different if you're selling to a consolidator and it's a simple multiple, not client, and you're just exiting. And because some people, can you still opt for de-authorization? Just sell, de-authorize, I'm done. And still get like you said, you're not in control. You're not in a phased buyout then, so you're in no control of the stickiness of the business, I suppose. But I
mean, you're not. But what everyone has to remember as well is, it's in the the purchaser has just a bigger incentive.
Of course they do.
To make sure that business sticks.
Of course they do.
They bought it.
Yeah, absolutely.
It's a long way in the future compared to what to yours. So it's a mutual agreement, and both parties are absolutely aligned in terms of the outcome, because you both want that business to stick. Seller wants it to stick to maximize their price. Purchaser definitely wants it to stick, because they've got to get the money back from what we've just paid the seller. So there's always a good alignment there.
Yeah.
Things like pipeline business is a conversation.
Yeah, no, that's good. I've had another couple of questions coming. One in particular, I just want somebody to elaborate in terms of charges. So whoever wrote that message, if you can just elaborate on that, I will get it answered for you. Somebody has to leave. They've got a client meeting, and yes, you will get a recording of the webinar as well. So we're gonna move on to some more submitted questions from attendees, and I'm going to skip this one because we've answered that. So the monetary value for clients over the age of 75. So just make sure you're selling if your spouse is under 75. All right, top tip for you.
Yeah, or sort of no now.
Yeah, or I don't know now. So specifically, what succession planning options are there? Say I'm working for a local DA firm. They've not facilitated a buyout of any advisor. What are my 1, 2, 3, 4 options?
So option one is to sell to another consolidator.
Yep.
One of the vertically integrated operations. 2 is to say if you've got a mate around the corner, whatever, that'd be interested in buying the client banks.
Yeah.
3 is join somewhere like us, like a network, and then sell to the network.
Yeah.
And they're kind of your primary, or you bring an advisor in to work with you, take over from the clients and work out some form of a buyout with them.
Some form of agreement there. Yeah, absolutely. Because there's not a million of options. There's not loads of options you have, but there's loads of people within those 3 or 4 categories that can help you, which is good.
Yeah. It's about finding what fits with you. What it comes back. I'm sorry, I keep repeating this, but it comes back to what you want to achieve.
Yeah,
as an advisor, where your priorities lie.
Yeah, absolutely. Now, I've included this question because I think it's quite interesting for somebody that is starting out in their advice journey, if you like. They're probably looking at the older advisors in the company that are seeing a few issues when it comes to succession planning, and probably thinking, well, hold up, how do I get ahead of the game here? So I'm seeing a lot of colleagues facing issues with succession planning. What would be your advice to someone who is way off of retirement, but is keen not to be in the same position as they see their peers in? So I like this question.
It's a good question. The problem with financial services is that the only consistent thing that we have is change.
Yeah.
So 20 years it could have taken place. But I think realistically, because of the way the demographics are moving, because obviously we keep reading about advisors being all retiring because everyone's quite old. I suspect in 20 years there will be fewer but easier options for you for when you retire. So the same criteria that you have today will apply, I suspect, in 20 years, which will be good client records, good evidence of servicing. So basically, you can demonstrate to a buyer why they should buy these clients.
Yeah,
that's the easiest way. In terms of options, again, it's about determining. 20 years is a long way in the future. In terms of where you think your career might be in terms of where financial advice might be.
Yeah.
I'm sort of always positive. I think independence will always be key, but I'm biased. And I think, my hope is that, having been doing this for a very, very long time, I've seen that the industry is moving back to the way it was when I first started, which was big direct sales forces, vertically integrated operations, because it was all insurance company based at that point. So okay, that's changed slightly, and a small IFA sector, and that's kind of where we're heading to. So, but the true IFA sector, I think, will always be healthy. That will always give you the best options.
Yeah.
Because you will always have the choice to move into a consolidator if
Absolutely.
But you've also got then the other options that are available within the IFA sector as well. So that probably would be my advice, would be aim for when you're retiring within 20 years, aim to be in the IFA sector for at least 5 years before your retirement.
Yeah, that'd be good.
Personally, stay there all the life, but that's me, I'm biased.
And what I love about that question as well is somebody that's got their eye on the end goal already. So it's the things that they're going to have in place, like the files, like the annual reviews, having everything in place from a very, very early start. It's just going to build the foundations of not only a great advice business, in my opinion, but the value as well. So hats off to that person that's planning for a sale, way in advance. I absolutely love that kind of stuff. So well done. I think we've covered this as well, David, right? So how do I maximize the value I receive when I sell? The value is all based on your multiples. So it's all about that ongoing service charge. So
good record keeping. That's the key to that one, because you need to, if you've got good records where you can clearly demonstrate your income, you are not going to miss any income. That can happen.
Yeah, I bet.
Yeah, if you've got 120 clients, for example, and each client has got, they've got random stuff in different places.
Yeah.
It's very easy to miss a bit.
Of course it is.
And if you've got good records, you'll always make sure you're tracking your income all the way through. That means you're maximizing your price. And also as well, for any new business that hasn't been on the books 12 months, you want to make sure that's factored in at a 12-month rate, not 3 or 4, 5, 6 months.
Yeah.
So it comes back to record keeping.
Yeah, no, it makes sense. The question that somebody asked me about charges, if you could message me after this, I'll cover that. But this webinar is purely for succession planning, but I will absolutely support you and answer the questions that you've got. So please feel free to send me a message after, and I'll help. If I sell my clients to another, I think we've done very good in the first 8 questions where we've covered off a lot of these, which is absolutely amazing. So if I sell my clients to another firm, what should I be wary of? And I think from our perspective as well, where we've seen firms get bought out by other firms and the mergers and the acquisitions, and I think that whole nothing changes. I think everything does change regardless sometimes in terms of the people within that organization, the culture and the setup and whatever else. You'd like to think that their investment proposition wouldn't change too much in the 2-3 years, right?
Yeah, again, this comes back to the questions I said. You need to ask a purchaser. The things to be wary of are there's Paul and I call it grey independent. You'll have to forgive me for that, but it's basically where you get firms that purport to be IFAs.
Yeah,
they've got either a deal in the background with a DFM, or they've got their own DFM in the background. And they say, well, we're independent, we won't disturb your clients, but we're going to move them onto this. That's client disruption.
100%.
So it's kind of be wary, go in with your eyes open. It doesn't necessarily mean it's a bad thing, but you need to be aware that's going to happen. So because you almost want to be priming your clients for this as well, because what you don't want is something to change and then all of a sudden it becomes your fault. Clients can be a bit prickly sometimes, can't they, on things like this? So these are things to be aware of. If you go into one of the consolidators, things are going to change, because that's what they do. So that's straightforward enough. So but it's about being very, very clear with what's going to happen with your clients, so that that's what you need to be aware of, and then really what you're doing.
Yep, brilliant. Is it better to bring someone in to take over or sell completely? Again, that's personal preference, right, on how you want to exit and your retirement plans. And again, that is all down to that all important question: what are your plans in retirement?
Yes. exactly.
If you have no plans and you probably could take another few years like the 80-year-old advisor you've got, then maybe you might want to bring somebody in and gradually hand over those clients and have a bit more of a phased retirement plan. That's preference, right, David?
It is, yeah. It comes down to, I mean, if you bring somebody in theory, you can mold them to do the things, the way you want your clients to be looked after. I mean, ultimately, they'll still have their own autonomy. That brings with it, it's kind of almost like a different problem in the sense of when you've got somebody working with you that's taking over, it's another person to consider. You've got all the regulations so on top of that, the T&C compliance and everything else. But what you do have is continuity. If you sell completely to somebody else, it's how you can basically maintain that continuity, and that's what you want to, And some people say, well, look, if you can bring somebody into your business and they literally just take it over from you, it's great. The business stays going, nothing changes. And if that's what you want, that's what you do. It's about basically it's about tailoring it to what suits you as an advisor.
Of course it does. I've got a question here, right? So it's a little bit lengthy, so I'm going to bend down, and I haven't got my glasses on, so apologies. So do you see any reaction to consumer duty, proof of ongoing servicing risk? So moving advisors in the future to go back to higher initial charges with lower ongoing, potentially reversing some of the post-RDR change, particularly amongst large houses, e.g. the SJPs and whatever else. Does that make sense?
Yeah, it makes sense. My personal view is I think if anything, we're probably going to move more onto ongoing fees than initials.
Yeah. So I see a lot of fixed fee advisors now, right?
Yeah, it's. I mean, we're kind of following. I mean, if you look at Australia, we generally follow. We're a few years behind Australia as a rule, and they're very much on a fixed fee model.
Yeah.
I think what everybody's kind of got rattled over consumer duty, or the industry, or the press and the noise has rattled everybody. In reality, I mean, everybody's still very unsure about what consumer duty is because, in fairness to the regulators, they haven't been very clear because I think what they're doing is they're letting the industry kind of come up with different solutions, and then they'll pull from that. I suspect in probably another 12 months when they get all the reports in at the end of July. And that will probably have good practice guides, and that'll give us more of an indication. I think realistically going forward, I don't think ongoing fees are going to come under pressure. I think what is going to happen is the justification for those ongoing fees is going to come under pressure in the sense of historically, years and years ago, it wasn't uncommon for, if an advisor was on the phone to a client, I'm going to come out to see you. Remember, we all have an interest to go and see the clients because you want to protect your ongoing fees. And that generally, as a rule, always happens. But what where previously, years ago, if you phoned the client and said, I want to come and see you, and look, there's actually no need, everything's fine, it's all hunky-dory, nothing's changed. All right, well, look, you know where I am if you need me, kind of thing. Yeah, done. That's fine. They didn't document it.
Right. Yeah.
And that's where everything falls down. So I think realistically, the big thing to come out of consumer duty is that you need to make sure you're documenting what you do, documenting your phone calls, documenting your, every time when you speak to the client, so you can evidence what you're actually doing on the servicing side. Because I think a lot of sort of more senior IFAs in where they've had their own practice or the appointed rep, the larger firms, they haven't had to do that. And historically, you probably didn't need to, 10, 15 years ago. And I think that's kind of the big change. But I think, we might see, if anything, I don't expect fees to change significantly, other than possibly even go up a bit, because the cost of regulation and being a business is going up. So, I think ultimately part of that's going to end up being passed on to clients.
Definitely. David, do you like the fixed fee model? Because I hear a lot of people that are just, regardless of the AUM movement for a client, whether the portfolio's grown or decreased, whatever it is, the fixed fee is the fixed fee. Do you like that model?
I think there's nothing wrong with it. There's a place for it in the market. I think some clients, want that. What you tend to find is we're in the kind of a learning period, I think, at the moment, and it's probably going to take another 3, 4, 5 years, where we're moving from advice. Literally, historically, was always considered free. And advisors were paid commission. Then RDR came in, and that came in. Although advisors weren't paid commission, the cost of advice still wasn't perceived as value, kind of thing. I think what we're seeing now, particularly with with the new advisors coming through, which is brilliant, and I think with clients as well, is that financial advisors now are sitting alongside accountants and solicitors. It's seen as a profession. Charter qualifications, fellowship, and all, and that's what it should be, because it's an integral part. We sit comfortably between solicitors and accountants, and usually end up correcting their mistakes.
Yeah.
In fairness,
Yeah.
Certainly in my experience.
Yeah.
So, there will be clients who value fixed fees because they understand that. But that doesn't necessarily perceive cheapness either, because fixed fees, as a rule, historically might actually be slightly higher than percentage-based fees. Clients are prepared to pay that because they value the service that they're getting.
Yeah. And do you think it's a bit of continuity there for the advice for the client as well? They know what they're getting. They know the cost of it, and that's really good. Yeah, fine. Look, if anyone's got any questions that they want to fire over, we've got about a couple of minutes left on the webinar. So the last question that I've got, again, we might have covered a lot of this, David. So clarity on whether I'm staying on or exiting. Again, we've covered this, right? Quick question. So does technology play a part in succession planning and its value? Absolutely, it does, right?
Yeah, it does. It's again, the technology comes down to what information it can provide to the buyer, and also the ease at which clients can be serviced. I mean, most clients these days sit on wrap platforms, so that makes servicing them easy. So it's about then how you can consolidate that servicing, particularly in the IFA sector. It's how you consolidate that information into one area. That basically makes it easy then for the advisor to service the clients. So again, it's about making your business the most appealing that it can be from there. So you want to make sure, again, it comes back to good record keeping all the time. Technology is moving on at a pace.
It is.
What you tend to find is that the limitations on technology at the moment isn't actually the tech that's out there; it's the providers. Because they're running so many legacy systems, it's very difficult to pull in things, like valuations from all sources. You can get in maybe 70-80%, but there's always that last 20. Then takes more time than just doing the whole thing manually anyway. So technology will have a bigger part to play, I think, in the valuations of businesses going forward, because it depends on again from your point of view as a seller, you want to look at what tech's being used within the purchaser, and are they leveraging the tech? So again, there's two types of tech in the market, really. There's the tech where they're trying to shoehorn clients onto particular wrap platforms. But then there's tech that's out there that actually is an advisor tool that's designed to help the advisor service the clients and look after them. So again, these are the questions that you will be asking, because again, you want to make sure that where the clients are going, they are going to be looked after.
Definitely.
It's kind of a double-edged.
I've got one final question for you. It's a bit of a curveball.
Yeah. If
you could change one thing in the industry, what would it be?
Regulator.
What was that?
The regulator.
What would one thing be about it?
Yeah, I think the problem is the FCA are big. They provide a necessary function, and don't get me wrong, compliance I think is a good thing. Compliance should be seen as a positive thing, because it's there to protect advisors, it's there to protect clients. In the industry, I think we need more transparency. And I think we're not getting that from the regulator as it stands at the moment, because you've got we need clarity in terms of who clients are dealing with, because you've got direct sales operations which call themselves partners, which are direct sales. I mean, when I grew up and worked at Sun Life when I first started, we were direct sales. And then you've got, I think there needs to be clarity in terms of whether you're actually genuinely independent or partly independent. I think it's all got very, 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 very confused. So, and I think having a smaller regulator that actually regulated advice would actually have better outcomes for clients, for firms, for everybody. That's the one thing I would change.
Right. Nail on the head. Nail on the head. Well, look, we've got no other questions coming. We've had a few questions. Everybody that's still with us, thank you so much for joining us today. I'll follow up with you all naturally to see if there's anything else that you'd like answering, or if we can help in any way. Please do complete the feedback form. It massively helps. Hope you all have a wonderful day. David, thanks for your time, mate. Really do appreciate it.
I hope it was some use.
Yeah, absolutely, mate. Thank you so much.
Bye.
Cheers. Bye.